fall in price of gold in quarter 2 of 2015 has attracted a lot of attention of financial investors across the world. In my presentation today, we would analyze the global demand and supply scenario for future analysis of gold pricing. Gold price is at its lowest level in the last 6 years during this quarter of 2015. Since March 2015, it has dropped down by 7% in this quarter, which is a very significant decline to the gold price. Large trade on SG and COMEX prompted this sharp fall between 228 and 230. This is that trade, and the fall happened from US dollar 1130 per ounce to 1086 per ounce. But it's strange that large trades happen the same time in both these exchanges. Gold demand fell by 12% to a 6-year low of approximately 915 ton, as you see here. This has been the fall in second quarter of 2015, while it was a stability reign in quarter 1 of 2015. Global jewelry affected by the weakness in Asia and Middle East, which resulted in this fall also. It's one of the contributors to this fall. As you see here, this is for Asia and Middle East, and this is for India demand, and both are in the decline in quarter 2. This weakness was reflected in the local pricing also. Here is the local Indian price. In December 2013, it was up by $140 per ounce from the MCX, while in this quarter it is below. It's in the negative from the MCX value. Bar and coin demand sinks and the ETF outflow slow to a trickle. As you see, it's towards the negative here, while if you see in the quarter 1, it was to the positive, even though the bars and coins demand was bit dropped or almost stable there. Frothy domestic equity market ate into quarter 1 gold demand in China. So here, as the equity market you see is going up, the gold is going down in volumes there. Comparing India with China, India is up by 15% on year, but below the long run average. These are the long run averages, while from 14 to 15 there is a growth, but overall it's below the average. While if you look at China, China is down by 7% year, but upward trend remains intact from long run averages. These are the long run averages, and from 2014 to 15 there is a drop, but it's above the long run averages. Central banks remain steadfastly committed to gold. So here you see Russia, it's bought nearly 70 ton of gold, while other countries there has been a drop. And if you see, China announced that its gold reserves has been boosted, so from 395 in November 2001 to 1658, which is a huge increase. Mine production increased by 3% to 786 in the second quarter of 2015. However, if you see in quarter 1, there has been a lower recycling of gold, so there was an offset by which offset the mine supply. There's been a continued decline in exploration and development activities, as you see here, and also the recycling activities subsided following the burst of activities in quarter 1. So in the quarter 1 there was a burst, whereas here in quarter 2 there is a decline in the recycling activities. We see the cause and effect and possible ramification. War on terrorism can lead to higher gold price, increasing money supply. A lower bond yield can lead to higher gold price, and slowing of USD GDP can have result in higher gold price. Similarly, liberalization of Chinese citizens to buy gold, no new gold mines, China-India growth, and stronger euro, all this can lead eventually to higher gold price. In summary, the cause of fall of gold prices: gold demand fell by 12% to about 915 ton, a 6-year low. Jewelry demand fell by 14% to 514 ton. Investment demand fell by 11% to 179 ton. ETF saw outflow of 23 ton. Central bank demands, although continue, total supply fell by 5%, and 3% growth in mine production was offset by recycling, which fell to 8%. Fell by 8%. So overall, these are the causes of fall in gold price, and you have to see how it would influence the future prices. Thank you.